Major support for these broadcasts is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's window company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, All Nation Renovation, Ackman Ziff Real Estate Group, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, Chelsea Lighting, Inc., Cushman & Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Goldman Properties, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Centurion Holdings, Corming Communities, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Muss Development, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Site Comply, Sterling and Sterling, Stonehenge Partners, Triangle Equities, The Wickoff Group, Urban American.
So where do you get money today? Somebody once said, I think it was Willie Sutton, you go to the banks because that's where they have the money. So today I have the people who have the money. I have the banks, the players, the guys who are lending money for certain deals. So we're going to find out what they like and what they don't like and how they want to borrow and how they want to lend today. My guests they include Steve Kenny, who's the Regional Executive and Senior VP for Bank of America Merrill Lynch. Dan Harris, who's the Executive Vice President and Chief Lending Officer for the Dime Savings Banks of Williamsburg. Ben Stacks, who is the Market Manager for the New York City region for Capital One Bank. And last but not least, Kevin Cummings from the state of New Jersey, who is the President and CEO of Investors Bank. So now that you're Investors Bank, do you think you're going to change the lending, that no longer you are a savings bank like him? I mean,
now, well, actually, 4 years ago, it would have been a change. And that's when we started this process of the transformation from a thrift to a commercial bank. Over the last 4 years, we've created a $4 billion commercial bank.
So 4 years ago, what were you?
We were in the transformation. Let's even go back further. In 2003, 80% of the assets were in mortgage-backed securities. We took those cash flows, put them into the residential portfolio. 2005, 2006, we started commercial lending.
So, here you are, the new kid on the block over there in this market, competing with the Capital One, a $200 billion bank who's going to be maybe close to 300, a Dime who's a couple of $1 billion, and then the proverbial 850-pound gorilla over here. Who do you want to lend to, and what kind of deals do you want to lend to in the market at the end of 2011, 2012?
Our niche in the marketplace is probably the $5 to $15 million loan. It may be a little too chunky for a community bank, and maybe the larger banks want to look at those loans over $20 million. So the multifamily space is very attractive to us right now. The residential construction is a little soft. Multifamily construction, we'll look at those deals. Commercial real estate, we've done up to $30 million transactions, all the way from as far west as Harrisburg, Pennsylvania, as far south as Baltimore, and up in Connecticut.
So you've gone out to Baltimore?
Yeah.
Isn't that a little bit out of your footprint, a little bit?
Our chief lending officer's son is at Johns Hopkins. No, but in the scheme of things, if we can drive to it.
if you can drive it to
In a
over
day,
there.
yeah.
Now, Kevin brings up an interesting thing. As a commercial bank, last week they were savings banks, but now they're a commercial bank. He's doing some construction lending. Capital One, Bank of America are in the construction lending. What are you doing in construction lending, and what do you want to do, and who do you want to lend to?
We're doing a number of construction loans to well-capitalized, highly experienced people. We're doing a bunch of multifamily loans, and we have done a couple of condominium construction loans, but on a very limited basis.
With regard to the condominiums, a report just came out today from the Real Estate Board on the statistics for the third quarter, New York City condominium, sales. And the condominium sales went up in the pricing, but the volume was down by 8% for the quarter. Now, part of that reduction may have been due to the fact that last year we had the first-time home buyer credit. So that was a situation. Certain condos are doing well. I mean, as I said in my symposium last week, Williamsburg, which came out in this report to be the most active in the condominium in the city of new construction, because there is the Edge and there's some other products. How do you look at the condo market today? I mean, we know that the Gary Barnett, the ultra, there are enough wealthy people from around the world who are going to buy very expensive. But what about the other condominiums?
I'll just say first and foremost, the way that we look at all of our lending activity is sponsor first. We have probably about 100 clients that have been longstanding clients of the bank. 25 to 50 of them are very active, and we do a significant number of repeat transactions and have a significant number of other business with them. So, and that's the way we look to try to continue to grow our book, centered around those funds and those families that we have a long track record with. As it relates to the condo space, we've been extremely selective, probably even more selective than Ben and Capital One, and it's first and foremost centered around the way I just answered is, who is it? Are we making money from them in other avenues? Do they have extremely deep pockets? And then do we believe in the project itself at the end of the day? We've concentrated on the high end of the market because I think we understand it the best, and I think our client base tends to migrate to that end of the business, and that's been our foray back into the condo space thus far. There are a handful of other projects that are out there. I know some of them on the Lower West Side and in Tribeca and the likes, and we're looking at all of those. We haven't pulled the trigger on those yet, and we've essentially told those clients that if you want us to consider providing financing, you have to expand the relationship with us more broadly.
It's a very interesting situation, and you're opposite each other, and both of you are opposite each other. You look with regard to sponsorship. That's the thing, the core situation. While in reality, in the rent-regulated multifamily, you're not looking in the same way on sponsorship, and either is Kevin, right?
The owner is very important.
I wait
wrong.
a second. I'm not putting the fact that the owner is not important, but you would lend if it's, because that is, it's like someone asking me why people went into the affordable housing business. And they went in when I did shows, and they said, the reason I went to affordable is because I really didn't have to put much money in. The government gave me money. And when I see a young guy who wants to try to enter the real estate market, the first thing they say that they're going to do is try to buy a 4-unit or a 7-unit or a 20-unit apartment building. And then they will go to investors, Dime, Sovereign, Astoria, New York Community, Flushing, and they will go to the 4 people in the similar manner of your business in the construction loans. True, you look at them and you do a credit check, but you don't do as much as one would say the scope of that person, because you're really looking at the property as opposed to the guarantee or the strength of the individual. Am I correct?
That's absolutely right. I mean, the owner is important. They knows how to manage that type of property, but the numbers drive the deal. the neighborhood drives the deal. You know what rents are appropriate or inappropriate, or if he's paying at rent regulated levels that most of ours are, you want to make sure that's below the market rents in the area. And there are markets where the rent regulated number happens to be higher than the market, so they have preferential rents. So you have to understand both rent regulation, of course, what neighborhood you're in, you know, what kind of money the guy paid for the building if it's an acquisition. But even in acquisitions, the product type is so favored right now that they're buying at very low cap rates, and it's very hard to finance 70 or 75% of the purchase.
Now, you know, I don't want to disagree. Capital One has a very heavy portfolio, you know, basically headed by your colleague Scott Swerdlin in this market. They're also in that business. My big question today is, since that market has been a preferred asset class today, you know, the DOA Piper event last week and even my own event, people want to buy multifamily, and people are paying very high prices for multifamily.
Guaranteed cash flow. I mean, you know what your rents are going to get. You don't have to worry about vacancy. You know, right now New York City is, in the rent regulated world, has almost no vacancy. The only issue you have is some collection issues in certain areas. So your cash flow is a given. Your net operating income is a given. So you just decide how much you want to make and how little you're willing to make. And some owners bring some real value to the equation, but you know what the math's going to be. Retail, office, you always have to worry about a tenant leaving.
Here's a question for all of you. In 2007, pre-Lehman situation, there was a comment both for rent-regulated apartments and office buildings that people who were buying these properties wanted to buy them vacant so they could get higher rents in the future. Today, if you look at a vacant apartment house, I mean a couple of units that are vacant, or you look at an office building, how do you look at that when you underwrite? Do you take it at the past rent, or do you listen to the purchaser saying that I'm going to get this type of rent?
Historical rents. You're rolling the dice on the future pro formas.
You know, 475 Fifth Avenue is the perfect example. Is, you know, vacant building is in the market. I don't know if anyone has officially tied it up yet, but we were backing a particular client, and the first thing that we looked at is how much cash are you putting in, and is there an alignment of interest there in terms of our cash and their cash, and then try to understand their business plan in terms of velocity, as opposed to just the absolute dollar number, and what type of construction work that they needed to accomplish there, and then what credit quality tenant they could attract to that particular location. And then, as Kevin said, it's, you know, what's the spot rent today, looking at comparables in that area.
I mean, that's a highly structured deal. I mean, we're, you know, and I think we're both, you know, willing to do some of those these days. But again, it has to be the right sponsorship.
But here, I think this relates to a big question. Leasing this year, the first 9 months in New York City, has been fantastic. We'll forget about New Jersey, the office, but New Jersey has had some, you know, they've had some large leases with Nova and some others. Leasing has been tremendous. August comes around, the downgrading of the U.S. government, the volatile stock market, and I will tell you, we're sitting in October today, and if I can call up my friends who are the honorable leasing brokers and ask them, are you that busy? They will make the following comment. They will say that if a tenant is really under the gun, that they need to take space within a year, they're looking. But otherwise, they're sitting. People aren't running. And they're negotiating. In my own building, the leasing manager, I see him. I said, what are you doing? He says, I'm trying to rent space. I said, what's happening? He says, they're asking me for 6 months. They're asking me for more TI. And when I say yes, they're coming back. So the leasing market, the office leasing market, and even though 475 is a good building, but you know what? There are a lot of buildings on Fifth Avenue like 475 that, you know, you don't know. 452, which is the best building, you know, the top floors do well. You can still get space on Park Avenue. I mean, we can joke, you're in One Grand Central Tower. I still call it the Lincoln Building. You know, there are different prices. So I'm not, you know, I'm a little worried about the market.
Well, we're focused on current cash flow. I mean, I did say that we would do some construction, but primarily what we're doing is stabilized cash flowing assets. On the commercial real estate side, on the multifamily side, obviously we're doing what my colleagues here are doing a lot of, which is stabilized cash flowing assets. But on the commercial side, we prefer to do cash flowing, stabilized, office buildings and retail properties. And we will take some leasing risk with, in certain transactions.
Based
Again,
on the sponsorship and
based on the spot. I mean, it's a broken record a little bit, but those people have stood the test of time. They know what's going on in the market. They have the capacity to handle a lot of different curveballs. So that's what we're focusing on.
Here's a big question. The hospitality market is the first market to do poorly and the first market to recover. And the hospitality market has added 20,000 rooms in the last 3.5 years. And there's another 2,500, about another 4,000, in different stages, real stages. I'm not talking about planned stages. I'm talking in the ground or shovel, something like that. Would you look at a hospitality asset today? Would you look at a hospitality asset today?
We have, and we will continue to. I think the parameters that I try to lay out for everybody is I do not want to be a commodity hotel lender. And the way that I try to define that is there a significant value proposition to where the hotel is located? Is there a significant value proposition to what the hotel is offering? And how does it differentiate itself from the one that could be right next door or the one that could be coming right next door? And then the last two things is, cash is king. How much cash am I going to have in? And where's that cash coming from? And what we've seen in many of the hotels that I've had interest in is that it's come from the flag, and that gives me a lot of security.
Kevin?
We don't have much of an appetite in that space. We have one sizable borrower that both of us know, and it's too much risk for a bank our size.
I agree, and I think you're not in that business, and I think that is the risk. I think there are some very good operators and people who have history, and the biggest question today, and this is exactly what happened when I was with Aria, we wanted to be in the hotel business, so we backed some guys who found some land, and we were going to build hotels, and then the world went dead. And now they're defaulted construction or defaulted land loans, not construction loans. And it's an operating business. And that's the question. I mean, how do you look at it?
Certainly on a low leverage basis. And we've looked at a couple of hotel construction loans, but we have not transacted on those. But we will definitely look at stabilized cash flowing hotels, much the way Steve described in his shop. So,
and I know the ULI is going to come up with their survey. We'll call it the Stoller survey from my last seminar, and also the DLA. There's been a big comment by investors that they're really not that interested in retail. So how, with this non-strong, urban retail, Manhattan retail, 5-borough retail is a different case. But how do you look at retail in case someone came to you, with a shopping center, let's say in Long Island? Would you look at how much, let's say it's not, there aren't that many great grocers. I remember when I used to say, hey, you had Waldbaum's a food emporium, but they filed Chapter 11. So how do you look at retail today in the environment?
We love urban retail, as you know, and we will do that all day. We'll go out into suburbia, we'll go into Nassau and Suffolk and Westchester and look at some, strip retail. We like the locals. We don't like too big of an anchor because, frankly, we're not in a position to underwrite the large anchors as well as they should be underwritten, since they're 50, 60% of your cash flow and maybe 75% of your square footage. So we'll look at them, but it's going to be on a low leverage. We're not going to leverage up those buildings, even if we get comfortable with the tenancy, the length of the tenancy, the success of the tenancies. We're still going to keep it on a lower leverage basis.
Kevin, New Jersey is like retail mania. You go down on certain roads over there, Route 18 has a very high vacancy, 17. It's big retail business, but how do you?
We'll look at we have a few actually along North Philadelphia, north of Hartford, and it's really the sponsorship. Who's the sponsor? It's a broken record, but it's, you got to look at the principal.
It's not even the question of sponsor. BRT, One Liberty, great borrowers. nobody knew that, Borders and Circuit City were going to be out of business. And when I did a retail show a couple of months ago, a very interesting phenomena came out. I had somebody from a very prominent Long Island shopping area, and he said Williams-Sonoma is changing their mantra. And I asked him, what do you mean by that? He said they're playing more on having the internet and smaller stores. And they're closing a lot of the stores because of the internet. And if you really follow it, and Kevin and I are older than the kids over here, but at one time, I tell the story. There was Sam Goody. There were once record stores. Then I said there were once bookstores. With the exception of Barnes and Nobles, we don't have any bookstores anymore.
What's the half-life of the average retailer? I mean, retail concepts in this country change fairly frequently. So, again, to go back to our sponsorship theme that we're having tonight, obviously that's very important, as is the location, but also your view of the durability of the location of the asset. And is that something that's going to, is it an infill location? Is it pioneering in any way?
So here's a question. Since we're talking about a lot of asset classes, I'll put you and I in the baby boomer situation. There are a lot of baby boomers, the aging population. So a lot of investors today are interested in assisted living, active adult communities, over 65 communities, and healthcare. How do you look at that marketplace?
We feel it's like hotels. You have to specialize in it. I think there's great opportunities in all of those areas, but it should be 100% of a group's diet, a specialized group that understands that industry, understands the demographics that you send out to originate those type of loans. Certainly not something for a community bank such as us.
We make the distinction between the healthcare component of it. If there's healthcare income associated with it, we have a healthcare and institutions group that would underwrite it. They may pick our brain on the real estate expertise, but then if there are restrictions around age, as long as there's not a healthcare component to it, we would underwrite it. We don't do a lot of that business in large part because our clients don't like those restrictions either. They want to have access to the broader demographic and marketplace that exists here.
Ben?
Actually, it's funny, we just started a healthcare lending group that's part of our commercial bank. It's not in the real estate group. So going forward, we will be looking at a lot more of these.
And in reality, New York City specifically has a dire need for assisted living.
Sure.
Because of, there's one in downtown Manhattan, Hallmark, that does unbelievably well because of the market. There's not enough space, and over there, New Jersey at one time was like kingdom of active adult communities. You can go over there. And there were too many built at one time.
The over 55 adult community, the no kids and townhouse, that's shot at that market. That's not doing well at all. The people that wanted to move into those townhomes can't sell their home in Bergen County because they can't deal with the price reduction.
See, and that's the interesting point. I'm happy you brought it up. So that market, when you think it's going to be there, and this similar problem happened in Long Island, they weren't able to sell.
Right.
So they built these developments, and they didn't work out, and they didn't sell. How about Jersey City, Hoboken? What's your thoughts on the market? I mean, that's still in your market.
We've looked at a number of multifamily construction projects there. Actually met on one this morning, and remain bullish on that particular marketplace. Again, at the right spot, underwritten rental rate.
Yeah, because in many aspects, I remember a number of years ago, I was at a seminar, it wasn't one of mine, and somebody said to Josh Muss, he was saying Hoboken is the sixth borough. He says, never, never. But in reality, Hoboken and Jersey City, because of the convenience, because of the path.
The key is, you just hit that's the key. The key is proximity to the transportation hub.
The price point, too. The alternative to Manhattan and Brooklyn now, because Brooklyn's gotten so expensive. Hoboken, Jersey City are more reasonable.
But you can get fooled by the price point if you're away from the path.
Mm. But part of the situation with the light rail in New Jersey, which has really taken care of, even though you're not there, that light rail has done a lot, I think with the properties that even Michael Box's group had done.
I think it's helped, but if you can avoid that transfer and the and avoid having to take 2 trains to come and commute into New York, obviously your rental rate should reflect that.
Industrial. What's your thought about that? Industrial market today.
Near the ports, very attractive. Warehouse space along the turnpike, pretty bullish.
I mean, there's not too much industrial in your marketplace over there. I mean, but, at one time, Long Island City and Williamsburg were industrial. There are still some, industrial and office in Long Island City. I mean, would you entertain, I know with the standard mantra, the sponsor, would you entertain that?
Yeah, no, we've done our fair share of industrial. We have some clients in upstate New York that own some significant industrial parks there. We've recently upsized and refinanced that particular credit. We're looking at a pool of assets in New Jersey right now, and we're actually looking at a ground-up construction industrial project in New Jersey. But like Kevin, proximity to the port, proximity to the airport, and/or the transportation hubs are obviously the key drivers.
Double dip. Last quick question with 1 minute left. Do you think we're going to have a double dip? I mean, 2012, this is a big question because of the market and everything else, oil, people who invested in gold 2 months ago paid $1,800, now they're down to $1,600. Paulson, one of the smartest investors, lost things. How do you think 2012 is going to be?
I'm going to remain optimistic, albeit cautiously. I think we're going to get close, and there's a lot of headwinds and a lot of concerns, and it's almost like there's so much talk about it, people almost want it to happen. I'm going to be the opposite. I'm going to say that I continue to believe in America.
I'm no longer Dr. Doom and Gloom.
I certainly believe in New York, and I think there's a lot of good that's happened and that is happening, and we need to focus on that.
Dan, 20 seconds. You're going to be.
I would love to be that optimistic. I don't see how we avoid a double dip, but being primarily in the residential rental market, that's fine with our portfolio.
Quick, got 10 seconds.
Cautiously optimistic, but not in New York.
And our newest commercial bank?
Bounce along the bottom, no double dip.
I'd like to thank the 4 of you, Steve Kenny, Dan Harris, Ben Stacks, and Kevin Cummings. See you next week. Major support for these broadcasts is provided by Bank of America Merrill Lynch and Perfect Building Maintenance, New York Community Bank, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, All Nation Renovation, Ackman Ziff Real Estate Group, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, Cassidy Turley, C.B. Richard Ellis, Chelsea Lighting, Inc., Cushman & Wakefield, Dime Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Goldman Properties, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Centurion Holdings, Corman Communities, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Muss Development, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Site Comply, Sterling & Sterling, Stonehenge Partners, Triangle Equities, The Wyckoff Group, Urban American.